Hello, I'm Chris Pedersen, and this is Stock Watch on Wednesday, the 14th of February, 2024. All advice is general advice and might not be suitable for you. Always consult your advisor before making any investments. All questions from viewers should be sent to stockwatch@fnn.com.au. My market observations. So far, the earnings season has been fairly lackluster. The outlook statement for companies is very important, and they've been cautious. We're just getting into a lot of the results now. Next week will give us a much better picture. Overall, my impression of global markets is one of cautious growth. There seems to be signs of a slowdown. The U.S. had a small rise in inflation. A small miss on expectations, well, in my view, that has nothing to worry about. Much ado about nothing. It is the trend that counts. 10-year bond yield has rebounded. It's not a concern to me yet until the Aussie 10-year gets close to 4.5%. I will reassess the risk if it gets to that level. Right now, steady as she goes. There's a lot of good companies to buy, and the earnings season is amazing because you get a 6-month update, everything is current, and you know who's performing and who's not. Here are the 10 best performers in January. These are the large cap out of the ASX 200. I love these charts because it shows you companies that have been doing well. It is a good lead list to then drill into to see which companies have potential to continue performing well. Same thing, here are the 10 worst performers in January. Is it just a temporary blip in their forward movement, or is this a permanent structural problem that you need to worry about, and if you're in it, maybe get out of? Here's consumer sentiment versus recession. This is the United States market, but if you look at it, you can see where there's a dark line going vertical, which indicates recessions. And what you see is right now, consumer sentiment is moving up. And based on historical record here, that indicates we're not going into a recession. Here's debt to GDP of 3 countries, Japan, China, United States. What is amazing is that Japan is so high, it's like 225% to GDP. However, people don't worry about it. It's because all of their debt is held in private Japanese hands. It is not necessarily an international problem. It is domestic, which they can handle. Next one down there is the United States, and that's at 123%, which is actually down from January 2021 when Biden took office. At that point, it was at 129%. So even though the U.S. debt has been soaring, and even myself is getting worried about it, on a debt to GDP ratio, the United States has improved. This is one of these things where the headlines can deceive you. The press likes to dramatize things that they don't necessarily need to. And then China, this is kind of disconcerting for me with China, is that their debt is just continuing to creep up at a faster rate than like the United States. This is a worry because China is the second largest economy. Can they continue to afford increasing their debt levels? That's a concern. 2 companies that caught my eye I wanted to share with you. One is HUB24 Limited. I've been watching this company for years, and I've never gotten into it because I'm not a believer necessarily in these financial service platforms. There are many structural reasons why I think that they could be obsolete. However, the exchanges here being the ASX and now the CBOE, and the regulators being ASIC, APRA, ACCC, and the RBA, they're not inclined to make changes in how we do clearing and settlement. Thus, these financial platforms are probably here to stay. The reason I haven't liked them is when you go overseas, your stockbroker provides everything that these platforms do, and they provide it to you for free. And these platforms charge money. But nonetheless, Hub is here. It's a large company. It is worth taking a look at. Now, what caught my eye was I saw a research report from Moelis, and then I looked at UBS research reports and a Morgan Stanley research report. And this is a good, solid company. And you can look at this 5-year chart and you see that it has good upward trend. And looking at the past year or even the past 4 months, it's really been spiking upwards. That is beneficial. And as Australia has more funds under management by individuals and self-managed super funds and what have you, that the demand for these platforms like HUB24 is just going to continue to increase. Yes, there will be price competition, but they're still doing very well. Let's look at the numbers. These numbers are estimates by Moelis. First of all, it's trading on the ASX under the code HUB, and it's trading today at $37.01. It's been inching up a little bit in the afternoon here. The 12-month price target they have is $36.88, which is about where it's trading now. Thus, why they have a neutral rating for it. The revenue growth rate they estimate from 2023 to 2026 is 17% per annum. That is excellent. And it has earnings per share growth in that period of 21% per annum, which is even better. And the dividend growth rate is 24% per annum. So this company is really performing well. But what are the ratios? The PE on the 2025 earnings estimate of $1.07 is 34 times. That's pretty high. But it is kind of justified based on those growth rates. The yield on the 2025 dividend estimate of almost 54 cents is only 1.5%. In my book, that's perfectly fine. This is a growth company. They don't need to pay out dividends. What you want is for them to plow earnings back into growing their business and continuing this very strong upward trajectory. Their free cash flow is around 5%, and the payout ratio on the dividend is 50%. So as I mentioned, it's a platform for financial services, good growth in revenue and growth in earnings. I agree with Morgan Stanley, and in their report, they say it still has modest upside. As a result, I'm not neutral. I like the growth. I weight it as a buy half weight. Last company today is A2 Milk Company. It's in New Zealand. Code is ATM. It's trading about $5.22. This is a 5-year chart. It looks absolutely horrendous. However, look at the far right. The past 3 months, it's been really trending up. It was at $4 just a few months ago, and now it's at $5.22. Is this a company that's turning around and going to move forward? Let's take a look. It has a market cap of $2.3 billion. Has a 12-month price target of New Zealand dollars of $7.32. That's a UBS price target. The revenue growth rate I show from 2024 to 2026 is 14% per annum. So these are forward projections. That's pretty good rate. The earnings growth for the same period is excellent at 29% per annum. And the dividend growth rate, well, it's actually growing pretty well, but you notice it's from 2025 to 2026. That's because it's not paying a dividend right now. And the first dividend they are paying is in 2025. But from 25 to 26, estimated to be growing at 17% per annum. That is very good. It's hard to project further out than 2026. We all have these long-term business plans, 3-5 years. The reality is, it is just an aspiration, and you're constantly adjusting your business plan as you move forward. It is good for a whole organization to have these 5-year plans because it's a template of what you're trying to achieve. But bear in mind, good companies are very flexible and make changes. Looking at the PE on the 2025 earnings estimate of 33 cents, well, the PE is 15.8 times. That is low, and that is because of its checkered past. When a company has been at $7, $8 and has plummeted way down, well, a lot of investors are nervous and don't want to go back in. They've been burned, they've moved away, they don't touch it. So there's a lot of skepticism with this company. That's why it has a low PE. But those numbers on the previous slide show that it is turning around right now, as long as they meet these estimates. The yield on the 2025 dividend estimate of 17 cents is 3.3%, and in 2026 it's estimated to be a 20-cent dividend. So that's all pretty good. Free cash flow is excellent at 6%, and the payout ratio, they're only paying out 50% of their earnings and profits as dividends. It's a New Zealand-based milk and milk byproducts company, export to China. It's a big business. It is truly starting to rally back. I rate it a buy. Let's see how far it goes. I think this has a potential to maybe retrace a lot of its losses from a few years ago. However, it's not going to happen overnight. Buy and hold. As always, if you want to learn more about anything I covered today, send an email to stockwatch@fnn.com.au and address it to me, Chris Pedersen. I hope you have a profitable week, and thank you for your time.